Hello, I'm Michael Hainsworth. Canada was among the first countries to raise the cost of borrowing as the inflation beast unexpectedly reared its ugly head. CPI peaked at 8.1% in June of 2022 and has been edging lower ever since the unprecedented wave of rate hikes. But unprecedented doesn't mean expected. The Bank of Canada was caught flat-footed as much as any other major economy. Meet Jeremy Kronick and Steve Ambler. Kronick is the Director of Monetary and Financial Services Research at the CD Howe, and Steve Ambler taught and chaired at the School of Management Sciences at l'Université de Québec à Montréal. They are the co-authors of the intelligence memo Slaying the Beast, the Bank of Canada's inflation fight, which asks the questions: would any other indicators have given the bank clues that inflation was coming? And where do we now stand in the inflation fight? There are also two of the three winners of the 2023 Douglas Purvis Memorial Prize, alongside Torsten Koppel for their research on the ballooning of Canada's balance sheet. Gentlemen, hello.
I'm Michael.
Congrats on the Douglas Purvis Prize win.
Thank you very much. It was very gratifying.
The Bank of Canada has a single mandate, as we know: keep inflation under control and around 2%. In Slaying the Beast, was your ultimate goal to establish how the bank let it get so high in the first place?
Well, maybe I'll kick us off. I think certainly understanding how we got to where we got to was a big part of the paper. And then also, are there clues, are there indicators that we could then use in the continuing fight? Because yet you mentioned that we peaked at 8.1%, but we're still around 4.5%. We had a little uptick last month. So the fight is still on. And so I think it was, in addition to understanding how we got here, also asking whether there are clues and things we can learn for the continuing fight.
Yeah, in fact, Michael, as you pointed out in your intro, the bank was nevertheless first off the mark in terms of starting to raise rates. It actually beat most of the other major central banks, even though it was behind the curve, but the other central banks were even more behind the curve.
Now, your analysis leaned on the Taylor rule. For those of us not steeped in U.S. Federal Reserve history, let's start by explaining it. Jeremy?
Sure. So the basic idea behind the Taylor rule is that you can look at the behavior of the deviation of inflation from its target, so in the bank's case, 2%, and the deviation of actual output from potential output, or the output gap. And those gaps between both inflation and its target and output and potential give you an indication of what the bank should do with its primary interest rate, which is the policy rate. And there are different versions of the Taylor rule as we've learned over the years, different clues about what should go into the central bank's decision with respect to the overnight rate. We've adjusted the Taylor rule here and there, but that's the basics of it.
Steve, I'm sure you taught the Taylor rule in school. Did Jeremy get it right?
Yes, he did. In fact, John Taylor of Stanford was actually on my thesis committee, so I've been familiar with it for a long time. It was originally devised actually as a way of explaining the historical behavior of the Fed, and it tracked what the Fed was doing very closely. And then it turned out that in the kinds of models that central banks use for forecasting and policy analysis, it turns out to give you pretty much, you're very close to what the optimal thing to do is in terms of your interest rate setting.
You determined that the Bank of Canada's policy rate lagged due to 5 contributing factors. Factor 1, the BOC underestimated the persistence of supply chain bottlenecks. What could it have done to accurately estimate the impact this would have had on inflation?
It did. It actually, I can't remember the exact date, but during the lockdowns or as the economy was opening up again, it realized that its traditional measure of the output gap, or potential output, which is basically a very slow moving statistical moving average of output, wasn't doing the job well. And that in fact, the economy was much more supply constrained than would be suggested by the output gap. So it started trying to come up with a measure of what it called supply, and to estimate the inflationary pressures as the difference between actual output and, rather than potential, supply, which was lower than potential output.
Yeah, I think this is one of the big problems, Michael, with this unique shock of the pandemic, right? Is we really don't have a lot of experience with shutting down entire economies right? And then having them reopen and trying to understand whether the economy's potential remains the same when we come back from a full shutdown of the economy. So I think it's we listed as one of the reasons why inflation ended up going where it went. But I think we do need to give the bank a little bit of a pass in terms of being able to estimate potential output coming out of the pandemic.
Yeah, one of the absolutely unprecedented aspects of this as well was we shut down quite a few sectors of the economy, except for what the government deemed to be essential. And what wound up happening is that a lot of people actually, especially things like hotels, restaurants, bars, and so forth, a lot of people, rather than just staying at home and waiting to come back to their original jobs, they left the sector completely and got jobs in things like manufacturing, which meant that once these more basically service sectors were allowed to open up again, they've been having, and I think they're still having a hard time hiring. So there's this kind of labor reallocation effect that happened, which I think was unexpected. And that actually worsened the supply constraints.
Jeremy, you wrote that it was difficult for the BOC to predict the size of the output gap due to the forced shutdowns of many sectors of the economy. Is this because we have no modern day equivalent to compare it against?
Yeah, I mean, that would be certainly, one of my primary contention, that it was just very difficult to know how everything would come back online. Online by online, I mean online and in person, but just how these warehouses would come back and businesses would come back, what the effect of all the grants and the queues and the CERB and all those things. We just don't have a lot of experience that we can model these things to understand what the behavior likely would have been, which made it a real challenge, to estimate what the economy's potential was coming out of this. But I will say though that we mentioned that issue made it very difficult to do forward guidance properly. And looking back, you probably wanted to be a little bit more careful with how much forward guidance you give in a world where you're not quite sure, what the output gap really is.
Now, Steve, you say monitoring headline inflation as a contributing factor to the Bank of Canada not slaying the inflation beast before it ravaged the economy. How so?
Well, one of the things that we learned from this unprecedented event was that when you're looking at wide swings in the inflation rate, I mean, inflation tanked in 2020. It actually was slightly negative for a time, for a brief period during the pandemic, and then once it increased above 2%, it started really took off in a hurry. But the traditional headline inflation measure looks back 12 months. It's actually the average of monthly inflation rates over the last 12 months. And that builds in a lot of inertia. And it can actually hide how quickly things are changing, either when inflation is taking off or more recently after it's peaked and has started to come down, which it did in June 2022.
This is the issue, with you using year-over-year inflation. Is it just it really takes a lot of things into consideration that happened quite a long time ago. And in normal times, when we're hitting the 2% target, I think that's fine. But when we're in these pretty hefty swings, these big inflation, this unanchored inflation, you really have to complement any work you're doing on the year-over-year measure with some shorter term, month over month or 3-month averages, things that are a little more shorter term in nature.
So then let's talk about the role of the bank's forward guidance. That was the fourth factor, because the promise of lower rates for longer was tied to excess productive capacity at a time when much of the economy was shut down. So how should the BOC have pivoted its thinking, Steve?
Well, they did pivot, as we said. They started looking at what they called supply rather than just potential output, because potential output became increasingly misleading. But even as late as early 2021, when, especially looking at the more recent measures of the inflation rate, like what it had been doing the last 2 or 3 months, it was starting to take off. The bank was still giving forward guidance and saying that they were going to keep rates low for a long time until, as they put it, all the slack in the economy was eliminated. But once again, that was, I think, that was basically still with an idea of the standard measure of the output gap rather than the new measure of output minus what they came up with as supply. So, they were still saying, and they maintained their quantitative easing until well into 2021 as well. They only eased off of that towards the end of the year. And by that time, inflation was already above, even headline inflation was already above target.
This is the challenge of looking at the year-over-year measure, right? So I think what was happening was the Bank of Canada, like all central banks, was interpreting some of this early bump as base year effects. Right. And as a result, they sort of just held on too long in terms of the stimulative measures. Again, they pivoted to QT quicker than other central banks. So again, I think we do need to give some credit there. But to your point on forward guidance, I mean, this is the challenge of having those low rates for as long as we had them, was it encouraged a lot of borrowing. Right. And now, as inflation is as high as it is, and having to raise the overnight rate as fast as the bank has had to, some of these borrowers, when they go to renew, it's going to be complicated for them.
So then what do you mean when you write that the BOC had a continued belief that monetary aggregates had lost relevance in predicting future inflation?
Okay, maybe I should handle this one. I've done more work and thinking on this probably than Jeremy has. I mean, they essentially have, for a long time, it completely ignored the monetary aggregates. For a while, they were actually sort of giving them very short shrift in the monetary policy report. So it'd be a very short paragraph on what they were doing and saying, well, maybe this might have something to do with what's going to happen to inflation. But I think the last time there was even a mention of the monetary aggregates was in 2017 in the monetary policy report. And this actually, there are reasons, and Jeremy and I write about this in our piece. If inflation targeting is working well and they're on average hitting the inflation target, except for what happens in between when they set their interest rate and their horizon, which is 6 to 8 quarters, then in fact, the only thing that should really be able to help you predict inflation 6 to 8 quarters out is the target itself. And if they're using all the information they have at their disposal intelligently and they're using the right model, then it's just shocks that intervene between when they set their interest rate and the 6 to 8 quarter horizon for hitting their target that actually affect the inflation rate. And you don't know that at the time. So, predicting inflation that far out, the only thing that should work is the target. But when inflation goes off the rails, as it did in one direction in 2020 and the other direction in 2021, then what we found is that money actually does regain a lot of its predictive power. There is real strong information content. And we look at the various versions of the Taylor rule in the paper, but we also look at the behavior of trend money growth and the difference between trend money growth and the trend inflation rate. And it just explodes in 2021. Just to scratch our own backs, we mentioned this in a couple of op-eds that we wrote early in 2021, saying that, this could be an indicator that inflation is coming. I think the only feedback we got on that was pretty negative, saying you must be kidding. We've known for a long time that money doesn't really tell us anything about inflation. But there were clear indications early in 2021. And if the bank had been looking at these measures, they might have seen some red flags there.
Your report suggests that there are many lessons for the Bank of Canada, including that they relied too much on estimating the output gap in crisis periods. Is the lesson here, Jeremy, to stop issuing forward guidance?
Well, I don't want to go that far. I think that, as I've said a couple times, that I think this particular crisis and this particular shock were about as unique as you get. I think in sort of, I don't want to say normal crises because there's probably no such thing, but in crises that we've seen historically, it's not that the output gap becomes completely unreliable as a measure. So I wouldn't go so far as to say we need to remove this. And quite frankly, when you're in a situation where you don't have any more room to lower the overnight rate, you need other unconventional tools in your toolbox as a central banker. We can debate the merits of QE, and that's been debated after '08. It'll be debated again after this one. But, forward guidance is a tool because if you can't lower the overnight rate, you can influence expected inflation. And therefore, hopefully lower real rates to create that additional stimulus. And so I wouldn't go so far as to say that, but I do think that we need to be, probably a little more careful in its usage. And I do think that, depending on how those borrowers that I mentioned who took out all that debt based on that forward guidance, depending on what happens to them, there might be a hit to the credibility of forward guidance if we need it the next time. So we'll have to see how that path goes.
Stephen, another lesson that you hope the BOC has learned is about the dangers of using the year-over-year CPI when there have been large swings in prices and relying on month-over-month measures as well. Are you saying we can't use either annual or monthly inflation data to determine the pace of inflation during an extended crisis?
I think you should be looking at all the measures that you can. Year-over-year inflation, 3-month annualized inflation, monthly inflation. The same thing with the core measures of inflation that the bank looks at. I know that, even on our monetary policy committee at the CD Howe, I know the National Bank had been calculating for a while a particular measure of core-like inflation that stripped out energy prices, food prices, and mortgage interest payments. And that actually, and we know that mortgage interest payments have been really fueling, one of the things that's been fueling measured inflation. And their measure actually was coming down very smartly and was actually within the target range, I think even a couple of months ago already. So it's another indicator. And now we're talking about, rather than the boom in inflation, now the disinflationary period since June 2022. Once again, when there's one of these big swings, just looking at headline inflation makes it look like headline inflation is very, very sticky and very, very, very slow to come down. And what we've been saying more recently in our opinion pieces is that it looks like actually inflation may be coming down more quickly than what headline inflation year over year would indicate. And to get back to money again, that's really swung in the other direction as well. It's our measure of what we call money growth gap, which is trend money growth minus trend inflation. Traditionally, it's above the inflation rate, the difference essentially being real growth. And as I said before, it ballooned just incredibly in 2021. So the gap was hugely positive. And now for the last little while, it's been negative. And what that indicates, if you look at especially household savings rates, which one of the unprecedented things about the pandemic was that household savings ballooned to over 25% in the second quarter of 2020. Some people kept their jobs, but couldn't spend. Other people were getting payments from the federal government and couldn't spend on anything, so they banked them basically, to a large extent in their checking and savings accounts, which are part of the monetary aggregates. And to me, and now they seem to be running them down. So the growth in money is below inflation. And to me, what that signals is that once they've sort of decided that they've depleted their liquid assets, to buy whatever they're wanting to buy. You know, more restaurant visits, more bar visits, more trips. A lot of people have already upgraded their houses and, you know, are doing renovations. But once that works its way through the system, then consumer spending, which has been growing very rapidly recently, and that sort of goes, I think, along with running down your liquid assets. Once that works its way through the system, then consumer spending as well is likely to drop, and inflation will come down.
So while hindsight is 2020, based on the lessons that have been discussed here, how would you have addressed inflation?
Yeah, hindsight is 2020. So I will stick with that as my opening salvo. But I think, look, at first, QE did so little after 2008 in the countries that did QE, in terms of everyone had this expectation that it was going to blow up inflation after 2008. And it really didn't, right? You had this huge ballooning of the balance sheet of the Fed and other central banks that did QE. We didn't, by the way. And we didn't get that inflation. So we spent the better part of, a decade plus trying to get inflation up from below the target, right? And so there was a lot of factors that I think, made it reasonable to assume that we weren't going to get big inflation this time around, and that some of what we were seeing were base year effects. That said, once some of the indicators were, there were indicators that were hard to ignore. And I think that the money growth, the savings, record savings rate, record deposits, charter deposits at banks relative to the size of the economy, nowhere to spend that money. So you get all this period of time where you have, more savings than you can imagine. And people were getting, the government was giving out CERB and really wasn't looking at who they were giving it out to, and understandably so. They wanted to rush it out the door, so there just were, once you started getting those signs from money growth, from the savings rates, from the deposits as a share of GDP, and you had to work through the fact that the year over year inflation is not a great measure, which we knew, when we have these kind of big swings. I think it's just a matter that we would have started hiking the rates earlier. That's really what it comes down to, right? It just, you would have hoped that the overnight rate would have started its upward march earlier, because it would have likely meant, one, a slower pace, and two, perhaps a lower terminal rate, right? And the thing is economies can function in low interest rate environments, and they can function in high interest rate environments. It's that quick pace move from one environment to the other environment that creates problems. It creates problems for households. It creates problems for financial institutions, for governments. And so that kind of speed, that pace, really is where the problems get created, I think. So it just would have been an earlier start based on some of the signals that we were seeing.
All right. So as someone with a variable rate mortgage, the dinner party question is the BOC done raising rates?
Well, maybe I'll start quickly since Steve's on mute, so that gives me a 1 second advantage to get started. So they paused in January. It was a conditional pause, and obviously the conditions changed such that they recently hiked the rate again by 25 basis points. I find it somewhat hard to believe that between now and the July meeting, the information that will come out will change their view back the other way. Right. So I could see another 25 basis point hike in July. But we weren't overly supportive of
Steve. Tell him he's wrong.
Yeah. Tell him he's wrong, Steve. We weren't overly supportive of this one. So I would hope that they wouldn't, but it's hard for me to imagine they won't. But that has to be it, in the sense of, I'm just not sure, to your point, that when all these renewals happen, that we can take much more.
But 2 days after the announcement, we actually got some bad news on the labor market front. Unemployment ticked up from 5 to 5.2. Employment growth was kind of stagnant. And before the next decision, I'm still convinced, and maybe Jeremy as well, maybe less so, that the uptick in headline inflation between March and April was just an aberration. That we're still on a downward trend, and we haven't actually reversed the trend, and we'll start going back down again. So if there will be new inflation numbers coming out before the next bank decision. If inflation continues to decrease or turns back down again, and given the labor market numbers, the bank may decide to pause again. But I think in any case, if they have one more 25 basis point hike, hopefully that will be it. They're not likely to start reducing rates until probably well towards the end of the year at the earliest. But as I've said in earlier interviews, that I used to have friends that would ask me what they should do when they were renewing their mortgages, and some of those people are no longer friends. But I think at this point, I would be looking for at most another 25 basis point hike, and a variable rate mortgage starts to look not so bad at this point.
Gentlemen, thank you so much for your time and insight, and congrats again on the Douglas Purvis Prize.
Thanks, Michael.
Thank you very much, Michael.
Jeremy Kronick is the Director of Monetary and Financial Services Research at the CD Howe. Steve Ambler taught and chaired the School of Management Sciences at l'Université de Québec en Montréal. I'm Michael Hainsworth. Thanks for joining us.
You've been listening to the C.D. Howe Institute podcast with Michael Hainsworth. Subscribe on iTunes, Google Play, and Spotify. The C.D. Howe Institute is an independent, not-for-profit research institute whose mission is to raise living standards by fostering economically sound public policies. The Institute is widely considered to be Canada's most influential think tank and a trusted source of essential policy intelligence, distinguished by nonpartisan, evidence-based research and subject to definitive expert review. Visit cdhow.org and follow us on Twitter and LinkedIn. Thank you.